This is Money Made Simple, the financial podcast that keeps it simple and gets to the point.
Kia ora everyone, and welcome back to Money Made Simple, brought to you by Simplicity. I'm Liv, and today Jenny is abandoning us again, or she probably thinks she's been kicked out, but means I can welcome another special guest to the show to talk about mortgages. So joining me today in the studio is Dan from our Home Loans team, so our co-head of lending. Welcome, Dan.
Hi, thanks for having me.
All good. So if you listened to last week's episode, you'll know that this actually ties into the type of debt that we talked about as good debt, meaning it can be managed to help you secure a better financial future. So today we're going to keep it top line, try to give a helpful view on the basics of mortgages in New Zealand, what exactly they are, the types of mortgages you can take out, and then a little bit about the specifics of Simplicity's mortgage business. First, let's hear a little bit about you, Dan. As, like me, I understand that you're not from a traditional finance background, right? Can you just maybe briefly tell us a little bit about your background, where you're from, etc.?
Yeah, sure. So originally I'm from Australia. You'll probably pick that up in the accent as we go. I've got a legal background. So I started practicing in Australia. I took a little bit of time off to sort of travel around and did the super yacht thing for a while, and then ended up back in the law scene in New Zealand here. And
why New Zealand? How did you end up?
I ended up following a girl over here, believe it or not. So
girl with a great name, right?
Yes, Olivia is her name. A different Olivia. And we ended up settling back here in New Zealand, and I did the law thing again for a while, and then got shoulder tapped by Sam to come and have a look at the home loans that Simplicity were looking at setting up.
Which is quite a different move, right? Like, were you kind of over law, or home loans just sounded a little bit interesting, or was it the Sam show kind of thing? What inspired you or convinced you to come over?
Sam's obviously got a very inspiring story and a vision for where he wanted Simplicity to go. I sort of got swept up in that probably a little bit.
As we all do, right?
And I mean, we're doing good things, and the whole reason behind the mortgages seemed very good. So that's why I decided to jump ship from the law firm and come across to Simplicity.
And Dan, from my understanding, you've been with the kind of lending business with Simplicity from the very get-go, right? You kind of helped set it up.
Yeah, we helped set up and establish the First Home Mortgage Fund, as it's called, and get everything in place to be able to assess mortgages and process them and pay the money out from sort of start to finish.
Cool. So you would have actually processed like our very first home loan that we gave out to one of our members, right?
Yeah, that's right. I can still remember them. They managed to settle just before lockdown, the first lockdown of COVID. So, it was a very satisfying feeling to get that first one out the door. And now we've got about 300 home loans that we've lent to first home buyers.
And some pretty big aspirations from Sam's part, right?
Oh, yeah, huge numbers. We'll see how we go.
We will. Cool. So now we've got those niceties out of the way. Let's get on to what we wanted to discuss today. And that's obviously all about mortgages. So let's start with the absolute basics. I know that until we had one when we bought our first house, I didn't actually understand it. So can you maybe give us a quick explanation of what exactly a mortgage is, what it's for, like why you take one out, and who offers them in New Zealand? Yeah,
sure. So, I mean, most people, when they're going to buy a house, are going to need to borrow some money, unless they've got their money in their back pocket or sitting in a savings
$1 million,
account.
right?
Yeah, that's right, casual milli. So unless you've got that sort of cash lying around, you're going to need to borrow the money, usually from a bank or from another lender. When you take out that home loan, the lender needs some security for you paying that money back, and that's in the form of a mortgage over the property that you've purchased. So if you get a home loan, the bank or the lender will take a mortgage over the property, which allows them to do certain things with the property if you refuse to pay the loan back, which means if you stop making repayments and you refuse to keep making payments.
You're like, no, I'm done.
Yeah. They can take the house off you and sell it to recoup the money that they've lent out to you. So that is the premise of a mortgage. Yeah. And that's sort of what it means. Okay, cool.
And so as you said, banks are kind of, I guess, the main or the biggest mortgage lenders in New Zealand?
Yeah, the banks are definitely have the biggest market share of mortgages in New Zealand, but there are a number of other different institutions and entities that provide mortgages. You've got building societies, credit unions, and other specific mortgage providers.
Right.
There's other lenders as well, and I think Simplicity might be one of the only, if not the only, KiwiSaver provider that provides mortgages as well.
I guess we are an anomaly in the industry for the most part. Cool. And in terms of how you pay back a mortgage, How does that kind of work in terms of your rates? Can you tell us a little bit about that?
Yeah, sure. They're long-term debt, so usually you pay them off over sort of 20 to 25, 30 years. Our standard loan term is 30 years. And a lot of institutions will offer fixed or floating rates. Fixed means that you can set the interest rate for a certain period of time and it stays at that interest rate. That provides some certainty about what your repayments are likely to be. Floating means the rate can sort of change and is in flux.
So why would you ever take a floating rate if you never kind of have that certainty?
Well, along with the floating rate usually comes a bit more flexibility with repaying the mortgage.
Right.
So a lot of those fixed rates will have break fees and other penalties and charges that are incurred if you decide to pay off more than the minimum. Whereas floating usually offers a bit more flexibility with repayments, and in return, a lot of the banks will charge high interest on floating rates because you can pay off a bit more than the minimum, which means they need to recoup and make that profit earlier.
And in terms of who would take out a mortgage, so, I mean, obviously we've got first home buyers.
Yeah, obviously we focus on first home buyers, owner-occupied properties. You've got investors need to usually borrow money.
Often 100%, right? Well, I know
borrow-
that we've borrowed all of ours.
Yeah, so investment properties, commercial properties, all sorts of properties, but it's important to remember mortgages really only relate to the purchase of property. If you're going to buy other assets and things, there's different charges and encumbrances that
types
get
of lending.
registered. So it's important to distinguish between loans and mortgages. The mortgage is the security, the loan is is the actual money.
Do you know, I
that's
didn't
drawn
actually
down.
know that.
Yeah, so the mortgage is the security. It's sometimes used interchangeably, but the loan is the advance of cash.
Cool.
And that is where most of the terms of fixed rates and floating rates and repayment obligations and all that come from, is under the loan. The mortgage is the security and basically...
Like the house kind of thing.
Yeah, it's the repercussions if you don't make the payment. It's the security for the lender. That's right, yeah.
Okay, cool. Awesome. So we've kind of got the basics of a mortgage covered. Let's move on to specific mortgage types, because I think that they can be super confusing, a little bit tricky to understand how mortgages actually work. There also seem to be several kind of same but a bit different types of mortgages, right? Can you maybe just run through the main few types for our listeners to kind of understand the differences?
Yeah, sure. The mortgage that most people will be familiar with is what's called a table loan. So table loans are the most common loan, and they require people to pay principal and interest, usually paid at regular intervals, so weekly or monthly.
Can I just stop you there? What's
Sure.
principal and what's interest?
Sorry, the principal is the balance or the amount of money that you borrowed.
Okay.
And
so you borrowed $1 million.
That's right. That's the principal.
The principal is you paying bits of that $1 million off.
That's
Yep.
right. And interest is the interest that accrues on that $1 million.
The lender makes money.
That's right. You're always going to pay more than the principal repaying the loan because someone along the line needs to make some money.
Unless
off
you've got
lending you the money.
a really cool family member.
That's right. If you've got the bank of mum and dad who love you immeasurably and have the cash to do it, then away
Maybe
you
they
go.
won't charge you interest, but
Yeah.
in the overwhelming majority of situations, then you're gonna be paying interest too.
That's right.
Cool. Okay, back to it. Table home loans.
Yes. So principal and interest of those usually pay it off at set intervals, weekly, fortnightly, monthly, something like that. And they're the most common type of loan. You can have fixed interest rates, floating interest rates. You can structure different parts of your loans in different ways. So you might have, taking the example of $1 million again, you might have $500,000 fixed for a year, you might have $300,000 fixed for 2 years, and then you might have the last $200,000 on floating or
Okay.
whatever.
So it's not always structured to just one type, one way of paying it off.
Yes, that's right.
Cool. So table home loans paying principal and interest at set period or periods of time. So what Simplicity offers to our members, our first home mortgage members, is a floating rate, right? So a table home loan, which you've just described, to
Yep.
first home buyers. So let's briefly, before we come back to that, explain the other types of home loans. We won't go into too much detail because we're not licensed to provide financial advice on mortgages, but probably good to just understand the other types of home loans out there.
Yeah, sure. So the other types of home loans are sort of things that are tacked on to a main loan. Things like revolving credit facilities or offset accounts, things like that. An offset account usually means that if you have money sitting in the offset account, you'll be able to use that money to reduce your balance, so the principal of the loan, which means that you pay less interest because you can only accrue interest on the principal that's left there. A revolving credit facility, that is sort of a little bit like a credit card, but with a lot less interest. It means that it gives borrowers the flexibility to dip in and out of that, and as long as that facility is surplus, then you won't pay any interest at all. And if it's in deficit a little bit, then you only pay interest on the deficit. So
an easy way to just kind of think about it would be like an overdraft account, right? And you can draw all the way up to that overdraft limit, and you pay interest on whatever is overdrawn.
yes, that's right.
Correct?
Yeah, absolutely. That's a better way of explaining it. And then sometimes you'll have the opportunity to go to interest only. This is usually not for first home buyers or owner occupied properties. It's more for investors who are looking to do complicated things with money and only want to pay interest for a little while. Some banks will accommodate them. So yes, that's the interest only component.
And I think just to add to that, because we have interest-only loans, often the reason for that, and our reason personally, is that we have an owner-occupied loan that we're focused on paying off before we start to pay the principal down on our investment properties. So there is a reason behind it. It's not just because we don't want to pay it off. It's more that we're focusing on paying something else off first, because it will actually cost us more in the long term not to pay that principal off. But we've got a whole nother massive loan that we're paying off first. So it's kind of just a prioritisation thing.
That's right. And I mean, you can talk to a financial advisor and they'll be able to give you all sorts of advice around how to structure loans and the best way to do it, and give you the best advice on how to manage those loans and what mortgages are required.
Cool. Awesome. Thank you for that. That hopefully provides just a little bit more context on how all of these different mortgage products out there in the market work. There's a heap of great resources available to find out more. Sorted.org's mortgage calculator is a really good one. You can kind of play around with years and interest rates and all sorts. Interest.co.nz has a whole lot of borrowing resources, and then Money Hub actually has a really good detailed explainer on the different mortgage types if you want to know a little bit more, and a comparison between them all, kind of advantages, disadvantages. So let's move on now to simplicity. So the type of loans that we offer, or the type of loan that we offer. Are we basically another bank? What do we offer? How are our mortgages structured? And who can apply to get a mortgage with us?
Yeah, sure. We're definitely not a bank. I'll start off with that. Our mortgages are very specific. They are for first home buyers only, and only our members can apply. And if you're borrowing jointly, as long as one person is a KiwiSaver member.
So it's not just any member of Simplicity. You have to be part of one of our KiwiSaver funds,
That's right. You need to be a KiwiSaver member, and that person also needs to be a first home buyer.
Cool.
And then we have quite conservative lending criteria that people need to comply with, because we're using people's KiwiSaver funds to fund mortgages. 20% equity, so an LVR, which is a loan to value ratio of 80%.
Lots of acronyms in the mortgage world.
Yeah, that's right. So you'll need to come up with 20% of the purchase price yourself. The affordability side of things, we calculate the mortgage so that only 35% of your after-tax income can be applied to repayments. So that obviously is at the time you apply and what the interest rate is at that date. And we only offer a floating rate. So just to keep it simple, it's a floating rate across the board, and at the moment there's no opportunity to sort of fix that rate or offer any of those sort of fancy offset or revolving credit facilities or stuff. Yeah. But what we do offer is the flexibility to pay it down as quickly as possible as well. So as I alluded to earlier, sometimes floating allows you to have more flexibility. With ours, you can pay it down as quickly as you like, which effectively reduces the term of the loan and means you pay less interest, and there's no penalties or fees or charges to do that.
Okay. And how do we set our floating rate? As you said, we're not a bank and we operate quite differently.
Yeah, sure. It's our investment committee that actually reviews our interest rate and decides on what that will be. They usually do that about every 6 weeks when the Reserve Bank reviews the OCR. But it's important to remember our floating interest rate isn't directly related to the OCR or swap rates or things like that.
So not necessarily like the banks set theirs.
That's right. So not like a traditional mortgage from a bank. Ours is a little bit different. Our interest rate is calculated to make sure that our returns sort of fair and as good as they can be for our members, because
that's what we're all about, right?
That's right. We don't have an obligation to make a profit. So our first home loans, they're funded through those investment funds and the KiwiSaver funds, and those funds would otherwise be invested in bank deposits and bonds. So it's another sort of fixed interest asset class. And we've got, as a KiwiSaver provider, we've got a fiduciary duty to act in the best interest of our members. So by funding mortgages with an interest rate that's higher than those other returns in bonds and
Cash
bank
and-
deposits.
yeah.
That's right. We should receive higher returns. So that's
right.
sort of the rationale there.
Although, in saying that, we are able to offer one of the lower cost mortgages on the market, right, to our members. So, yes, we have that fiduciary duty to provide good returns, but it's also pretty good for members who are taking out the home loans.
Yeah, that's right. Banks make their profits from getting the money from deposits and lending it to borrowers, and there's a margin there. But for Simplicity as a non-profit, we're giving some of that margin back to our KiwiSaver and investment funds in the form of higher returns and some back to the borrowers via lower interest rates. So that's how we balance that there.
And it tends to be lower than the general floating rates that are out there from the banks or other non-bank lenders, right?
Yeah, I mean, there's no guarantee at all that our interest rates will be lower.
Of course.
But, from time to time as we've gone on, we've managed to keep our floating rate lower than the bank's fixed rate special, so even better than the specials that they're offering.
That's like for a 1-year fixed rate, right?
That's right, yeah, from time to time. But obviously there's no guarantee, but that's what we're going to continue to try to do.
And that's fairly unusual, right? As you went over before when you were explaining about how fixed and floating rates work, floating rates tend to usually be set higher than a fixed rate.
Yeah, absolutely. Our ability to do that all comes down to being a non-profit and wanting to pass on as much of the return to our members as we can.
Cool. Awesome. So there we have it, mortgages in a very quick nutshell. Obviously, there's heaps more that we could discuss around mortgages, mortgage providers, home loan structures, etc. But that will be for another day, another episode in the future. So hopefully this episode and our friend Dan here have given you a general understanding of how a mortgage works, what type of loan you might apply for, and how Simplicity's first home loans work in particular. Thanks so much, Dan, for joining me, and hopefully we can get you back on a future episode soon.
Yeah, thanks for having me. I'd love to be back.
Cool. Next week, we'll be discussing the 5 biggest benefits of KiwiSaver from our point of view and how you might want to make the most of these benefits. Bye for now. This podcast contains personal opinions and is intended to provide educational information only. It doesn't relate to your particular financial situation or goals and is not financial advice or recommendations. Simplicity New Zealand Limited is the issuer of the Simplicity KiwiSaver scheme and investment funds. For product disclosure statements, please visit Simplicity's website, simplicity.kiwi.